Welcome to Tech Money Madness, your daily U.S. stock market podcast. Today is June 26, 2026.
And what a morning it's been already, right?
Oh, absolutely. I mean, if you opened your brokerage app this morning, you probably thought the tech sector was just completely collapsing.
Yeah, taking a pretty brutal beating across the board.
Exactly. The Nasdaq is just bleeding out. But, and this is the crazy part, if you look just one screen over on your app, the Dow Jones Industrial Average is hitting all-time historic record highs.
Right, which makes zero sense on the surface.
Right. You have these two major indices, which are supposedly measuring the exact same U.S. economy, and they are telling completely opposing stories. Like, how can the economy be crashing and booming at the exact same time?
Well, that contradiction is basically the defining puzzle of the market today. We're looking at this massive underlying shift in where capital is moving.
And more importantly, why it's moving there so aggressively.
Exactly. Because the daily market briefing we're pulling from today, it reveals these underlying currents that are basically pulling the global economy in completely opposite directions.
So today, we are taking all those sources, the market briefing, the new inflation reports, the geopolitical updates, and we're doing a deep dive to make sense of what is actually happening to your money.
Yeah, we need to connect the dots here.
We really do. We're going to bridge the gap between a historic Middle East peace deal, some genuinely terrifying inflation numbers, and this really brutal reality check for artificial intelligence stocks.
Because, I mean, it might look like three separate news cycles on your feed, right?
Right.
But it is all deeply, deeply interconnected.
Totally. So to understand why your tech stocks are plummeting while these traditional industrial stocks are soaring, we kind of have to start with the geopolitical macro picture.
Yeah, you have to zoom out first.
Right.
Because everything we are seeing downstream in the markets today, it all originates from the situation with Iran.
Let's lay out the facts on that real quick. So we have this historic U.S.-Iran peace deal on the table right now. And as part of this agreement, the U.S. has issued these sweeping Iran oil sanctions waivers.
Right.
And, just from a purely factual market mechanics perspective, completely stripping away the politics, regardless of what side of the aisle you're on, this policy has unlocked billions of dollars in revenue for Tehran.
Yeah, and regardless of how anyone views the policy itself, the strict economic reality of it is that this represents a fundamental shift in the global energy supply chain.
Because that oil is back on the market.
Exactly. By lifting those sanctions, a massive amount of formerly restricted oil is now theoretically in play. And the immediate ripple effect of this deal is that shipping traffic is finally beginning to recover through the Strait of Hormuz.
Which is huge. I mean, the Strait of Hormuz is arguably the single most critical choke point for global energy on the planet.
Oh, without a doubt.
Something like, what, a fifth of the world's daily oil consumption passes through that one narrow waterway?
Yeah, it's basically the bottleneck for the entire global economy. When traffic through the strait is threatened, the cost of moving energy just skyrockets.
Because insurance premiums for the cargo ships go way up.
Right, insurance goes through the roof, and the ships have to take longer, way more expensive routes to avoid the area entirely.
Right.
Now, the briefing notes that while traffic is technically recovering right now thanks to this peace deal, the market confidence remains incredibly fragile.
Shippers are cautiously returning, but a newly signed piece of paper hasn't completely erased the anxiety of the past few months.
Exactly. You don't just forget months of disruption overnight.
When you look at the global supply chain, it really functions like a major artery in the human body.
That's a good way to look at it.
Yeah, because of this peace deal, the blood, meaning the shipping and the oil, is finally flowing again in the Strait of Hormuz. The massive blockage has been cleared. But the global economic body is still dealing with this severe lingering damage from when that artery was blocked. Like, we're surviving, but the organs took a massive hit.
That's spot on. The blood is flowing, but the trauma to the system is still manifesting. And that trauma is showing up right now in the form of the financial receipts.
The bill has arrived.
The bill is definitely here. The geopolitical conflict caused an energy surge over the last several months, and the invoice for that surge just landed on our doorstep.
And the numbers in this market briefing are brutal. I mean, let's break down what you are actually paying for as a consumer right now.
Yeah, let's look at the data.
Wholesale prices rose 1.1% just in May. And the briefing explicitly ties this spike directly to that previous surge in energy costs.
Right. It's a direct correlation.
And then consumer prices rose 4.2% annually, which puts us at a 3-year high.
3-year high. And, the central banks, They're looking past those headline numbers, and they are staring directly at the core metrics.
Which are even more concerning.
Yeah. The Federal Reserve's preferred gauge, the core inflation rate, hit 3.4% in May.
Wow.
Yeah, that is the highest print we've seen since October 2023. But the number that really sets off alarm bells in Washington is the Personal Consumption Expenditures Price Index, or PCE.
Right, the PCE.
It's expected to show a 4.1% annual increase.
Okay, so for everyone listening who hears these acronyms thrown around on financial TV all the time, why does the Fed care so much more about the PCE hitting 4.1% than the Standard Consumer Price Index? Like, what's the actual mechanism there?
That's a great question. So the Standard Consumer Price Index, the CPI, essentially measures a fixed basket of goods. It tracks the cost of a very specific static list of items over time.
Okay.
But PCE is different because it actually accounts for human behavior, specifically something called the substitution effect.
Oh, right.
So if the price of beef gets too high, you stop buying beef and you buy chicken instead.
Yeah.
PCE adjusts for that pivot.
Got it.
So when the PCE spikes to 4.1%, it means that even the backup plans are getting too expensive.
Oh, wow. So consumers are trading down to cheaper alternatives, but those cheaper alternatives are still rising in price.
Exactly. And that indicates that inflation is deeply, deeply embedded in the economy. It's not just isolated to a few luxury goods or a specific sector.
That really brings it right down to the kitchen table.
It does.
And it's not just an American problem either. The briefing paints a picture of global pain. I mean, the UK economy shrank 0.1% in April.
Yeah, shrank.
And their analysts explicitly attribute this contraction to the prior Iran conflict driving up costs. Their inflation is holding at an uncomfortable 2.8%.
And you see the direct fallout of that embedded inflation in the labor market, especially overseas, but here too. Manufacturing is incredibly energy intensive.
Right.
When the cost of fuel and electricity skyrockets because an artery like the Strait of Hormuz is under threat, factories simply cannot maintain their profit margins.
Which brings up a stat from S&P and our sources that really stopped me in my tracks. They are reporting that factory job cuts in June are nearing financial crisis and COVID levels.
Yeah, it's staggering.
That is a terrifying benchmark. Yeah. We are talking about 2008 and 2020 levels of job losses in the manufacturing sector.
Because factories run on incredibly thin margins and high energy consumption.
Right.
When those energy costs double, the only lever management has left to pull to stay solvent is labor. They have to cut costs, and tragically, that means mass layoffs on the factory floor.
Wait, hold on. I need to push back here for a second.
Sure.
I am looking at this timeline, and it seems completely contradictory.
Hmm.
If we have this massive U.S.-Iran peace deal on the table right now, and shipping is actively recovering today, why are factories cutting jobs like it's 2008?
Right, the timing feels off.
Yeah, shouldn't the market be celebrating the cheaper oil and hiring more workers? Are we just paying for yesterday's crisis today?
That's exactly what's happening. It seems entirely backwards if you view the economy like, a real-time app on your phone, where a policy change instantly updates the balance sheet.
But it doesn't work like that.
Not at all. The economy operates on a massive lag. Think of it like trying to heat a giant, drafty stone castle in the middle of winter.
Okay, I like this.
You can finally get the furnace working and crank the thermostat up to maximum, which is the equivalent of signing the peace deal, but you are still going to be freezing for the next 3 hours while that heat travels through the massive stone walls.
Oh, that makes so much sense.
The factory job cuts we are seeing in June are the direct result of the energy price spikes from months ago. Contracts were negotiated at higher energy prices. Corporate balance sheets took on debt to cover those spikes.
Right. Those financial wounds don't instantly stitch themselves up the moment a treaty is signed.
Exactly. The cold is still in the wall.
The cold is still in the walls, which perfectly explains why the central banks, the supposed adults in the room, are completely split on how to handle this.
Oh, the divergence is fascinating.
It really is. The European Central Bank, the ECB, just hiked interest rates for the first time since 2023, specifically to combat these lingering energy costs. But then you look at the Bank of England, and they held their rate steady at 3.75%. They are essentially crossing their fingers and hoping the Iran peace prospects will naturally cool things down.
We are witnessing a fundamental divergence in monetary philosophy right now. The ECB is taking a very active, aggressive stance.
Because they're looking at the data.
Yeah. They see the 2008 level job cuts and the inflation data staring them right in the face, and they are choosing to inflict more pain via interest rates to just crush demand entirely.
In the Bank of England.
The Bank of England is taking a forward-looking, albeit much riskier, approach. They're betting that the thermostat has been turned up, and they just need to wait for the geopolitical resolution to naturally do the inflation-fighting work for them.
Wow. Okay, so this high inflation, high cost environment, which as you said is heavily driven by energy and geopolitical lag, brings us to the most fascinating part of today's deep dive.
The tech sector.
The tech sector. Because this environment is finally catching up to the market's golden child. Big tech and artificial intelligence.
It had to happen eventually.
Right. For the last few years, tech stocks seemed completely immune to the laws of gravity. But inflation comes for everyone eventually.
The immunity has definitely worn off. We are finally seeing the physical limits of the digital world.
What do you mean by that?
Well, software still requires hardware, right? And hardware requires energy and raw materials to actually build.
And we are seeing that hit consumer hardware right this second. Apple is officially raising prices for the MacBook and the iPad.
Yeah, which they hate doing.
They really do. And the reason given in the briefing is directly tied to higher semiconductor component costs. The literal raw materials required to build the tech are getting just too expensive to absorb.
When a company with the massive supply chain leverage of Apple actually has to pass costs onto the consumer, you know the underlying inflationary pressure is severe.
Yeah, they usually just eat it.
Exactly. But the real story here is what is happening to the stock valuations of these tech giants. We are witnessing a major aggressive sell-off in what Wall Street calls the Magnificent Seven.
It's wild. The Nasdaq 100 has dropped over 4% just this week.
Yeah.
That is a massive wealth destruction event for an index of that size. The top losers list reads like a who's who of the tech world today.
Let's hear the numbers.
Okay, so NVDA declined 1.59%, Meta fell 2.7%, Amazon dropped 3.1%, Microsoft slid 3.5%.
Ouch.
And Apple is also right there among the top losers. The most active stocks overall today are NVIDIA, Apple, Microsoft, Amazon, and Tesla, and they are all bleeding. Why the sudden panic?
Well, the market is entering what analysts call the show-me state.
The show-me state.
Right. Investors are fundamentally reassessing these stretched valuations. Because for the past few years, the market has just heavily rewarded the pure promise of AI.
Oh, yeah, you just say AI on an earnings call and your stock goes up 10%.
Exactly. Companies were given blank checks to build out massive AI infrastructure. But capital is becoming much more expensive because of the inflation we just discussed.
Because interest rates are up.
Right. When money isn't free anymore, the market suddenly demands mathematical proof that these investments will actually pay off.
So proof of what, specifically? Like what metric are they actually looking for right now?
They are demanding proof of cash conversion and return on invested capital, or ROIC.
ROIC.
Yeah. In plain English, ROIC is simply an investor asking, for every dollar I give you to build this massive AI data center, how many cents are you giving me back in actual profit this year?
Oh, wow. Okay.
Investors are looking at the billions being burned on servers, data centers, advanced chips, and they are highly concerned over the sheer scale of the spending without a clear line of sight to the actual revenue.
Let me try to visualize this.
Yeah.
It feels like the AI boom over the last 3 years has been like building a massive state-of-the-art multi-billion-dollar highway system across the country.
Okay, yeah.
And investors were incredibly happy to fund the concrete, the bulldozers, and the labor. They loved the idea of the highway. But now the highway is built, and those same investors are standing at the toll booths asking, where are all the cars?
That is a perfect analogy.
They want the toll money.
Yeah.
They want the revenue, not just a really expensive piece of infrastructure sitting there.
Right. The concrete has been laid. But if the cars, meaning the profitable consumer and enterprise AI applications, if they don't start paying tolls immediately, the investors who funded the highway are going to take a catastrophic loss.
And they know it.
They know it. In a world where consumer inflation is running at 4.2%, institutional investors do not have the patience to wait around for empty toll booths.
No.
The time value of money has shifted. They need returns now, not a promise of returns in, 2030.
So if institutional money is fleeing the crowded AI software and mega cap tech stocks, if they're essentially abandoning the AI highway, where is all that money going? Because billions of dollars don't just evaporate into thin air. They move.
Capital never sleeps. It just relocates.
Right.
And this brings us to the answer to the mystery we set up at the very beginning of our deep dive. Why is the Dow hitting records while the Nasdaq plummets?
Yes, why?
We are witnessing a classic structural capital rotation.
Okay, explain the mechanics of a capital rotation for us. What does that actually look like on Wall Street?
A capital rotation happens when large institutional investors, so we're talking pension funds, hedge funds, asset managers, they decide that one sector of the economy is too risky or overvalued, and another sector is undervalued or safer.
Yeah.
They literally sell billions of dollars of stock in sector A and use that exact cash to buy billions of dollars of stock in sector B.
The money rotates.
Exactly, the money rotates. Today, the briefing shows investors are rotating away from these crowded, speculative growth stocks in the tech sector and pouring their money into non-AI traditional sectors.
And it completely explains the Dow Jones Industrial Average.
Yep.
The money's rotating into industrials and healthcare.
Because when investors get spooked by high inflation and the speculative nature of, empty AI toll booths, they retreat to what is tangible.
Things they can touch.
Right. They retreat to companies that make physical things or provide essential services that human beings need regardless of what the economy is doing.
Right, people always need healthcare.
Exactly. Industrials built the physical world. Healthcare keeps people alive. These are defensive, cash-generating sectors that offer a safe harbor when tech gets too volatile.
But the briefing highlights a really fascinating split, even within the tech sector itself. It's not just all of tech that's losing today.
No, not all of it.
Hardware is winning big. Look at Micron, ticker symbol MU. They just delivered stronger than expected earnings, and their stock absolutely surged up 15.74% in a single day.
It's incredible.
And that rising tide dragged up a whole class of hardware and chip stocks. SNDK, AM, QCOM, and WDC are all the top gainers for the day.
This is what we call the picks and shovels dynamic of a gold rush.
Oh, I've heard this phrase.
Yeah, during the California gold rush, the people who consistently built lasting wealth weren't the ones panning for gold in the river. It was the merchants selling the physical picks, the shovels, and the denim tents.
Let me make sure I understand this nuance, because it feels a little counterintuitive. NVDA is the ultimate poster child for AI chips, right?
Yeah.
And they're dropping today. But Micron, which makes memory hardware, is surging over 15%. Why are investors rewarding the companies making the basic nuts and bolts right now, while punishing the poster child of the AI revolution?
It comes down to the mechanism of commodity pricing versus future platform valuations.
Okay, break that down.
So Micron makes memory chips. Memory is a physical commodity. It's the essential nuts and bolts required not just for AI, but for every standard server, every laptop, and every smartphone on the planet.
Right.
Because they sell a physical commodity that is in high demand right now, Micron can pass the cost of inflation directly onto the buyer today.
Oh, I see.
Yeah, Apple has to pay Micron's higher prices to build the MacBook, and Micron books that cash flow immediately.
So they're basically printing cash today, which investors love in a high inflation environment.
Exactly, and that is the exact opposite of NVIDIA's current dilemma.
Because NVIDIA is selling the future.
Right. NVIDIA makes the hyper-advanced brains of the AI operation, but their current massive stock price was heavily based on dominating the software and platform ecosystem years into the future. When interest rates and inflation are high, the mathematical value of $1 you might earn 5 years from now goes down significantly.
Because a bird in the hand is worth 2 in the bush.
Precisely. Investors are looking at Micron's earnings and seeing actual immediate cash flow. They aren't waiting for a future AI application to become profitable. They are profiting off the physical building blocks being sold right this second.
Wow.
The market is severely punishing the high-concept platforms and aggressively rewarding the tangible commodity hardware.
So let's pull all of this together. What we're seeing in today's market action is not just random noise, and it's not just a temporary blip on a chart. It is a massive vibe shift in the global economy.
Absolutely. It is a structural realignment of how capital values the future versus the present.
The market is simultaneously trying to digest a geopolitical peace deal that is unblocking the world's most vital energy artery, while also battling the very real lingering symptoms of a stubborn 3-year inflation high.
The cold still in the walls.
Exactly. And as a result, we're watching in real time as the smartest money in the world rotates out of the futuristic, crowded promises of artificial intelligence and moves into tangible, boring profits like healthcare, industrials, and physical hardware commodities.
The market is demanding reality over potential.
It really is. It's a profound shift, and it leaves you with something pretty major to think about as you watch these trends unfold in your own portfolio.
Yeah, it's a lot to process.
If the massive AI infrastructure boom is facing a harsh cash conversion reality check right now, just as global energy prices might finally stabilize from this new Middle East peace deal. Are we about to enter a completely new economic era?
It's a great question.
An era where boring, traditional companies become the new growth engine of the global economy. What actually happens to these seemingly invincible tech giants if those multi-billion-dollar AI toll booths stay empty?
It could redefine the next decade of investing, honestly.
It really could. Well, thank you so much for joining us for this deep dive. Keep questioning the headlines. Look for the deeper currents. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.